Hello and welcome to a discussion that provides an overview on leases. Watching this video will help prepare you for class. It is important that you view this before class so we can learn more together in class. After viewing this video, you will be able to locate items related to leases on the financial statements. You will also be able to determine if a lease is an operating lease or a capital lease, and if the lessor has a direct financing or a sales type lease. You will also be able to account for an operating lease. You are looking at JCPenney's balance sheet. Take a moment and see if you can find the line items that would include leases related to JCPenney stores. A liability for lease payments is reported on their balance sheet as current and non-current. Here's the cash flow statement for JCPenney. Leases are a form of financing, and cash related to leases is reported in the financing activities section. Take a moment and locate the line items related to leases. The cash flow statement reports payments related to capital leases. In a lease transaction, the lessor has an asset that the lessee needs. The lessor transfers the asset to the lessee in exchange for cash payments. Payments are made monthly, quarterly, or annually. In this class, we will work with leases with annual payments. How the lease is accounted for is determined by whether or not the lessee is using the asset for a short period of time, or if the lessee is really purchasing the asset through the lease agreement. How long the lessee uses the asset and how much the lessee pays to use the asset determines the accounting. When the lessee uses the asset for most of its useful life and pays for most of the fair market value of the asset, the lessee is really, in substance, purchasing the asset through a financing agreement. There are two types of leases, an operating lease and a capital lease. A lease is considered to be an operating lease when the lessee is just using the asset. This occurs when the lessee will not take title to the asset, pays only a small portion of the total cost of the asset, or uses it for a short period of time. A lease is considered to be a capital lease when the lessee is, in substance, purchasing the asset by making payments to the lessor. A capital lease gives the lessee the same risk and rewards of ownership that they would have if they were purchasing the asset. Let's talk about operating leases first. A lease is accounted for as an operating lease when the lessee is just using the asset for a short period of time relative to the life of the asset. The lessee will not take title to the asset and will return the asset to the lessor. An operating lease is fairly easy to account for. The payment is considered a rent expense for the lessee and rent income for the lessor. The asset remains on the balance sheet of the lessor and the lessor depreciates the asset. Rent expense and rent income is recorded for the amount of the payment. The lessor records depreciation expense on the asset that remains on their balance sheet. The lessee does not report the asset or a liability on their balance sheet. The obligation is considered to be off-balance sheet financing since there is no liability on the balance sheet for the promise to make payments to the lessor. A lease is a capital lease for the lessee if, in substance, it is a purchase of the asset even though the lease agreement doesn't specifically state a purchase. This is true when any of the following occur. The lessee takes title to the asset at the end of the lease, pays for more than 90% of the cost of the asset over time, or uses the asset for more than 75% of the useful life. A bargain purchase option gives the lessee the right to purchase the asset for an amount that they would not pass up, and title passes at the time of the purchase. With any one of these, the lessee has the same benefit and risk and rewards of ownership, and this is really purchasing the asset with financing. The same four requirements for the lessee also apply to the lessor. However, the lessor must also meet two other criteria. The lessor must be reasonably sure they will collect the payments, and they must be certain of the costs related to leasing the asset. If these additional two criteria are not met, the lessor accounts for the lease as an operating lease. It is possible for a lessee to account for the lease as a capital lease and the lessor to account for the lease as an operating lease if one of the four criteria are met and these two criteria are not met. A capital lease for the lessor will either be a direct financing lease or a sales type lease. In a direct financing lease, the lessor provides the asset to the lessee in exchange for payments that pay only for the cost of the asset plus interest. The lessor's only income is from interest. No profit is earned on the asset. The present value of minimum lease payments is equal to the cost of the asset. In a sales type lease, the lessor earns profit on the sale of the inventory and earns interest. An example of a sales type lease is Boeing leasing aircraft to American Airlines. American leases the aircraft at the fair market value, a price higher than it costs Boeing to manufacture the aircraft. Boeing earns gross profit on the lease of the aircraft and also earns interest for financing the purchase. A sales type lease is recorded similar to selling inventory. In a sales type lease, there are two amounts to consider. One for the fair market value, which is the sales price, and one for the cost to manufacture the asset. The only difference in accounting for a direct financing lease and a sales type lease is the first journal entry that is made when the lessor transfers the asset to the lessee. The type of capital lease only affects the lessor. There is no impact to the lessee. The direct financing lease reports a lease receivable at the cost of the asset. There is no profit on the asset. All profit will come from interest earned as time passes. In a sales type lease, the lessor is selling inventory and financing the sale with a lease. The sales price will be paid with the lease payments. Inventory decreases, and the cost of goods sold is recorded for the cost of the inventory. The income statement of the lessor will report sales, cost of sales, and gross profit. The journal entry is very similar to the journal entry that is made when inventory is sold on account. The only difference is the lease receivable account is used instead of the accounts receivable account. The total minimum lease payments include payments during the lease term and bargain purchase payments. The lease term includes any periods the lessor has the right to extend the lease. The total payment amount will pay for the cost of the asset plus interest. The present value of the minimum lease payments is the amount for the cost of the asset only and does not include interest. Present value essentially means the amount of cost without interest. After viewing this video, you should be able to locate items related to leases on the financial statement. You should also be able to determine if a lease is an operating lease or a capital lease, and if the lessor has a direct financing or a sales type lease. You should also be able to account for an operating lease. This concludes our overview of leases. We will continue our discussion on leases in the next video. Thank you for taking the time to be prepared for class. It is very much appreciated.